Every dollar you touch is an IOU, created not from wealth, but from a bargain struck in 1913 that rewired money into perpetual debt. Today, $1 in your pocket means $1 owed, and trillions of dollars in interest funnel upward year after year. So who controls the promise behind every bill, and what happens if the ledger ever demands to be balanced? The answer changes the story of every dollar you have ever earned. In December 1913, President Woodrow Wilson signed the Federal Reserve Act into law, creating a new institution at the heart of America's financial system. The Federal Reserve was given sweeping authority to control the nation's money supply, not by holding gold or silver, but by issuing notes. Each note is a promise, not a store of value. The law is clear. Federal Reserve notes shall be obligations of the United States. Every dollar bill stamped with the words, Federal Reserve note is a legal liability, not a certificate of wealth. This was a departure from the old world of money as something tangible. Instead, money became a claim, a formal IOU, rooted in the ability of the government and its central bank to backstop every promise. The system was designed after meetings on Jekyll Island, where bankers and lawmakers mapped out a structure that would bind the nation's currency to debt. Paul Warburg, Frank Vanderlip, and Senator Nelson Aldrich were among the architects, aiming to stabilize markets and prevent bank runs by centralizing power over credit. From that moment forward, every new dollar entered circulation not as an asset, but as a liability, created when the government issued bonds and the Federal Reserve bought them by crediting banks with new funds. The word note itself means a promise to pay. In this framework, money is no longer a thing. It is an obligation, a contract, a ledger entry. The entire value of the currency rests on the promise that these debts will be honored by the government, by banks, by everyone who uses a dollar. A single Treasury bond sets the process in motion. The Treasury issues the bond, an IOU, into the financial markets. By law, the Federal Reserve cannot buy that bond directly from the Treasury. Instead, it must purchase on the secondary market, typically from a primary dealer such as a major bank or investment firm. Treasury is where this begins. Step 1, the Federal Reserve Open Market Desk announces a bond purchase. Step 2, the desk buys, for example, $1 billion worth of bonds from a primary dealer. Step 3, payment is not made in cash. The dealer is credited by adding $1 billion to the dealer's bank reserve account at the Federal Reserve. No vaults open, no trucks roll. The Fed simply increases the bank's electronic reserves, a liability on the Fed's balance sheet, matched by the new asset of Treasury bonds. For the primary dealer, Treasuries go out and reserves come in. The dealer's bank now holds a fresh $1 billion in reserves, which can be used to settle payments or to support new lending. The Federal Reserve's books record the bond as an asset and the new reserves as a liability. Every dollar credited is balanced by a dollar owed. There is no net increase in wealth, only a reshuffling of obligations. This is the essence of modern money creation. A $1 bond becomes $1 in new reserves, and that reserve is itself a promise, not a tangible asset. The entire process unfolds on digital ledgers, governed by statutes that prevent the Fed from buying directly from the Treasury. Each step leaves a clear trail of matching assets and liabilities, ensuring that for every new dollar there is an equal and opposite debt somewhere in the system. Inside the commercial banking system, money multiplies far beyond the original reserves created by the Federal Reserve. New reserves arrive at a bank, and the bank is not required to keep all of that money sitting in the vault. Traditionally, a bank might keep 10% of deposits on hand and lend out the other 90%. If a customer deposits $1,000, the bank keeps $100 and loans out $900. That $900, once spent, lands in another bank, which then keeps $90 and lends out $810. Each step creates new deposits, new loans, and effectively new money on the books. By the time the process is fully played out, that original $1,000 in reserves can support up to $10,000 in deposits across the system. This is the banking multiplier at work, expanding credit far beyond the base money supply. But for every dollar created, there is a matching liability. Someone owes the bank the principal plus interest. That means the system issues more claims on money than there is physical cash available. As loans are repaid, money disappears from the system. If everyone tried to pay back their debts at once, the money supply would shrink, leaving obligations unmet. That contraction is the core of the debt trap. The system depends on continuous new lending just to keep the aggregate money supply intact. This dynamic concentrates wealth upward. Interest payments flow to banks, bondholders, pension funds, and other creditors, while borrowers carry the obligations. The result is a steady extraction of income from debtors to creditors. History offers warnings. Credit contraction helped trigger the crash of 1929, and a freeze in lending and liquidity nearly collapsed markets in 2008. Those moments show how fragile the system becomes when confidence or credit dries up. The banking multiplier trap is not a technicality. It is a structural feature of modern money. As long as new loans must be made for the system to survive, borrowing and repayment will shape who gains and who pays. Every year, more than $1 trillion in interest flows out of the United States Treasury to a complex web of creditors. The first in line are private banks, collecting payments on the loans and mortgages they create. Pension funds and mutual funds, managing the retirement savings of millions, rely on steady streams of Treasury interest to meet their obligations. Insurance companies also hold vast portfolios of government bonds, using the income to pay out claims. Foreign central banks, most notably in Japan and China, receive tens of billions of dollars each year, as they hold more than $1 trillion in United States government debt combined. The Federal Reserve itself, as the single largest domestic holder, collects interest on its portfolio, though most of its earnings are eventually remitted back to the Treasury. The hierarchy of creditors stretches from Wall Street to Main Street, from global financial centers to small-town pensioners. But the direction of the payments is always upward. Taxpayers fund the interest, and the recipients are those who hold the debt. In fiscal year 2023, the government paid more than $1 trillion just to service its obligations, a figure that now rivals, and soon will surpass, all federal spending on defense. Behind every dollar of government debt, there is a creditor waiting to collect, and the system ensures that wealth flows toward those who own the claims. If every bank loan in the country were paid off tomorrow, the money supply would collapse overnight. That is the hidden fragility at the core of the system. Money exists because someone, somewhere, still owes a debt. When debts are repaid, deposits, the digital dollars in checking and savings accounts, vanish from the ledgers. In 1929, as borrowers rushed to settle their loans and banks tightened credit, the result was catastrophic. The U.S. money supply shrank by 1/3 in just 4 years. Businesses failed, unemployment soared, and the economy spiraled downward. The banking network, designed to multiply credit, became a mechanism for destruction when the flow reversed. No new loans meant no new money, and the web of obligations that supported everyday transactions began to unravel. The lesson is stark. The modern economy cannot shrink its debts without risking collapse. The only way to keep the system running is to borrow more, just to replace the money that disappears with every payment. In this cycle, stability depends not on repayment, but on the promise of perpetual new debt. Beyond U.S. borders, the cycle of debt and payment radiates across the globe. More than $7 trillion in U.S. Treasury securities are held by foreign central banks and sovereign funds, according to Treasury International Capital data. Japan and China alone account for over $1.8 trillion, with dozens of other nations relying on these holdings as the backbone of their own financial reserves. The US dollar's role as the world reserve currency means that governments from London to Riyadh must keep vast stores of American debt to settle trade, stabilize exchange rates, and ensure against crisis. Every coupon payment from the US Treasury to these foreign official holders represents a steady transfer of wealth outward, an unbroken chain of obligations linking American taxpayers to creditors around the world. Forecasts from the Congressional Budget Office now show interest payments rising faster than the economy itself. By 2029, the government will spend more on interest than on all non-defense programs combined. Within a decade, interest outlays are set to surpass defense spending. Some economists argue this is manageable if growth keeps pace. Others warn that compounding interest will eventually crowd out everything else. That will force hard choices or risk a loss of confidence. Competing theories offer no consensus, leaving the fate of a debt-based system an open and urgent question. Every digital dollar remains a promise, owed, enforced, and collected. As United States interest payments approach $1 trillion a year, the cost of money itself shapes global power in everyday life. In a world built on debt, who holds the note decides the future. That reality is not abstract. It is now.